Alright, hey everybody, this is Jack and welcome to your Friday video. Alright, so let's talk about what this is right here. That's basically this entire week since the Friday to the Sunday overnight to Monday futures. Every Friday I do this video to talk about where we have been and where we might be going. The reason why this week has been so interesting was due to the fact that we went through earnings with the big tech names, and even though we can take a look at this heat map and we can pretty much, we all know what it means. Amazon was down for today, but overall, if you were to look for all the earnings declines in Microsoft, Google, Amazon, Apple, and Meta, you know that on average they're down plus 10%. So why is it that the market is not down, right? That's the question, and that's the question we're trying to answer, or at least the environment that we're trying to trade around heading into what I think is going to be even a more interesting earnings week next week, because a lot of the names that are reporting next week, mainly Tuesday, Wednesday, Thursday, are what I call like the societal glue names. There's not big tech, and while big tech is very important, it's not everything. So one thing that we can do is kind of assume that because this is how we traded this week with the big names reporting, that's actually a net positive move in the markets, not just from 3,500. But really just where we started out this week, which was more around 3,750. And y'all know that in the last Friday video, the main point of this was as long as we're above the 50% retracement of the September highs, 38.5, then that's a good sign for continuation. And what it could mean for next week is if there are, even if we have subpar or even slightly positive guidance higher, or just overall the earnings reports are not just overall crummy, then we can assume that the market might just go higher due to not everything falling apart, right? So there's this case for crossing the Rubicon, which is basically going to a certain point and not being able to turn back due to the influx of short covering, and I think that's where we're at. So that's why I want to take a look with you at the daily chart to get some more of an overhead view, like a bird's eye view of the market. And this is the Fibonacci that I've been keeping on my charts for the longest time, and this is the low, and the 50% retracement of that sits right here, and this is where we ended up on Friday at 39.23. So what does this all mean? Well, what I think, and the way that I'm going to be looking at this market next week, is as we take one more look with a 2x zoom out here, these are the Fibonacci's, and these are the things that I think that are looking like proof that we could actually go and retest the daily 200. So that dark blue line right here is certainly something that we don't really see a whole lot of. We did it one time in August, but mainly whenever we talk about those larger moving averages, we're talking about retesting the magenta line, which is the daily 50. We're talking about the aqua line, which is the daily 100. So now we closed at Friday right at 39.20, which lines up perfectly with the daily 100. All right, so if we are looking at an argument, or if we're looking for an argument for things to continue to go higher, we might want to look at the squeeze histogram, which still has light blue on it, and it's coming out of that squeeze. Now, if you were in the day trading room, welcome if you're new. I basically just did a video about how this move right here looks just like this move, and if you look at this squeeze, that it also looks like this squeeze, and that what would be the end result? Maybe a move like this, and maybe a move up to 41.35, which is the 50% retracement. Instead of going back to September, going back to way further back in the spring of this year. I'm just calling it March because I think it's like right at the end of March, so March, April. And so you kind of have this cluster of low downside extensions, but you also have this kind of feel for what would a 50% retracement mean on two larger levels. And if you think about, what do we do as humans? We look for patterns and we kind of attach ourselves to patterns. So if you've been short this market, you've been doing great. You've been shorting everything from a higher high, and man, you're doing great. You've conditioned yourself and you're just continuing to just really knock it out of the park on the short side. Well, the reason why I don't think that's going to be working out is because I think what they're going to do is kind of take advantage of the conditioning and prop this thing, or at least there's enough speculators here left in the market to start hopping out of their short positions, and I think that's what we saw this week. I think also what that was what this was whenever we were looking at this move. So it's kind of a mirror image of all this together in one big box, and halfway through where we are now. And I think the other half of this leads us to 41.50, or at least that 50% retracement of the spring highs that takes you back to basically April. All right, that's my take on all this. It'll be interesting to see like what if it's just terrible? What if we just start to sell off and all that kind of stuff? Well, look, I think that's very possible too. I'll be the first one to tell you that I feel like it's very very possible that this could fall apart, but we have some other things going for us that I think outweigh the negatives. So I'm optimistic on this market heading into the midterm elections in November. I'm also thinking that any type of negative reaction that we've had for an interest rate hike, if you kind of look 2 or 3 days later after the fact, it actually turns a little bit more positive. So I think there's more of an argument to stay long in the markets. I think selling put credit spreads up to 4,000 or at least up to 4,050 makes a lot of sense for this Friday, or at least the following Friday for next week. There will always be another time to short this market. I think it's up here this time and not so much right here, right now. So the other thing too, I know there's some other traders that have been paying attention to like fear indexes or just VIX. Daily chart on VIX has a squeeze that's firing to the downside. That's kind of my other side of the argument that kind of helps things go along to the long side for the S&Ps. This thing's firing to the downside here. And so that's kind of one thing that you look at for an inverse relation to the S&Ps. And it's worth considering. I don't think that getting through tech earnings like we did and the market being up on average like 250 to 300 points this week, that's not really a bad thing. So I think regardless of all the bad news and all the negativity that could go on in one's trading mind, I think I also go, all right, well, where would they want to take advantage of a retail trader in the fear that the market's going to fall apart? And that's where I want to be long in the market and say, you know what, I kind of challenge that. It takes a little bit more courage to be long these days in the market. And so I'm going to kind of stick with that frame of mind until it doesn't make sense. Let me tell you why this picture would be different. I'd be a little bit more bearish on this market if there was no squeeze, if we were not above the September high Fibonacci retracement, and if we knew that there was a midterm election that we could actually rally into. So that's my take on the S&Ps. It's a little bit long-winded, but I like to be thorough. Gold, I like to give out a little bit of my thoughts on gold. I do think we're going to continue to see lower lows in gold and revisit the low that we put in at 1621. Might even have an argument for going sub 1600 through the first part of 2023. Now that's a little bit of out of scope analysis for this video, but if you take a look at the hourly chart on gold, it does not look good. So any move higher on gold is a shortable situation. And even a full retrace back up to 1657 or this 786 at 1665, all this stuff to me on an hourly chart looks like a short. If you change that hourly to a 2-hour, it gets even more interesting, because now you get to see just how soft gold really is. No pun intended. So I look at this and I go, well, if there's a daily chart that looks really bad, where can we expect the next extension to the downside? Even if we did take out the lows, where would that be? And my 1272 sits at 1567, and that also kind of means that we go back to the spring of 2020 lows in gold, and you can see this on a weekly time frame. So this is your frame of reference as to where we've gone, which was positive 2,000, almost 2,100. Now we're kind of coming back to earth, and I think we'll have a soft landing at 1500 at some point later on. I'm giving this like 30, 60 days, and then maybe that is the low that we should expect. And from there, I'd like to think that buying this would start to turn into a good idea. But until we hit sub 1600, until we start to break down to those 1272 extensions, I still have to be short this chart due to the fact that there's a voodoo line at 1517, or there's Fibonacci extensions down to 1567, and that would also be that kind of the completion of this large cycle to the downside. And then from there, I think it all goes back up again. All right. Have a great weekend. Thanks for the time. I'll see you in the day trading room or in the futures room. And if you're new, welcome. Hope to see you in the rooms. Have a great weekend. We'll see you. Thanks for watching this video. If you've enjoyed the video, be sure to like and comment down below to help us out. Also, be sure to subscribe and click the bell icon so you can get notified when we release our next video. And if you want to watch us trade in real time using our own money, go to simplertrading.com to learn how to sign up. Good trading, and we'll see you in the next video.